We have had a massive rally when it comes to gold and silver, followed by a sharp sell-off during the New York session today. So let's go over what's driving gold and silver fundamentally, how that aligns with what price is doing structurally, and then look at the exact execution game plan and levels that I'm going to be watching going into the end of the week and even early next week. Starting off with the fundamentals, we already kind of covered this in the weekly outlook and the last couple of market updates that we have been doing. You guys should have access to that already. But quick recap, this metals move that we're seeing, it's not because of inflation. It's about currency credibility, hedging behavior, and policy uncertainty. We have seen persistent US dollar weakness even as equities are holding up, which tells us that global investors are hedging exposure and not exiting US assets outright. And when hedging demand rises, then hard assets like gold and sometimes silver will attract capital. At the same time, the Federal Reserve has entered a credibility sensitive phase as of yesterday. The rate decision was a hold, but the market was focused more on the forward guidance, the Fed independence, and the political pressure and how the Fed is handling that from the Trump administration. And historically, when credibility becomes the variable, then volatility will expand, and that's exactly what we're seeing right now. So the key takeaway from a fundamental perspective is that gold and silver have been flying because the market is repricing policy and currency risk. But after a move this large, positioning becomes crowded and crowded trades will unwind violently, which is exactly what happened today. When we're looking at gold specifically, we saw that massive rally that happened because it's being used as a hedge against policy uncertainty and dollar weakness at the moment. Silver is pretty much the same thing for the macro reasons, but silver has additional fuel sources, which is that it's thinner, it's more momentum driven, and much more sensitive to speculative flow. So we also saw signs of speculative demand, especially out of Asia, and the heavy derivatives activity. And that matters, especially when we're looking at our short-term to swing trade opportunities, because when options activity becomes one-sided, then dealers will usually hedge in a way that can mechanically reinforce that momentum. But on the other side of that, when the market reaches peak euphoria, even the strong trends can sell off sharply because then metals become a source of liquidity, which is exactly what happened this morning, which basically means that investors, traders, or any market participants sell what is up right now to cover the risk elsewhere. So today's drop doesn't automatically mean that the macro thesis is dead. It just means that the volatility is elevated now and the market is resetting positioning. As of today, both metals are no longer in the clean breakout continuation that we were looking at earlier this week and late last week. Liquidity has been taken at highs now, and volatility has expanded. So this means that we're not going to be trading any impulsive moves or chasing any breakouts. The edge for us is now going to shift to structure reactions and then reacceptance of trades and failed moves or no trade at all. So let's go ahead and take a look at gold first based off of the 1 hour time frame, and you can hop up to the 4 hour time frame in the daily. But on the 1 hour time frame, we see those clean candle closures here. The primary decision zone right now where price is sitting is at this 53,300 or 5300 and 5320 area. So we're just going to do this. You can also create a zone, but overall, where price is sitting at right now, this is very important because this was the prior all-time high acceptance where we saw price consolidating and then a massive break up above that. We never came back down to retest that area until we started seeing that liquidity being taken at that 5,600 mark and then a massive sell-off. This is also the higher time frame breakout base and a psychological pivot. Above this zone, gold maintained a bullish structural bias. Below it, we're going to shift into a corrective rotation here. Above this level, the liquidity highs around 5560 to 5600. They're already taken. So you can create a zone here. That's not a level that we're going to be trading here just yet. But around this level, we already had liquidity that was already taken. So that move is already done. It's not tradable. But below that structure, we have the first sell side liquidity pocket sitting at around 5180 to 5200, which is pretty much around this area, where we had that massive sell-off and the price rejected that and then pulled right back up. If we continue breaking below this 5300 to 53 or 5280 level around this consolidation, if we continue pushing down, this is going to be our first target. And then below that, we have our 5080 to 5120 area, which is going to be our deeper correction move. The scenario one for gold that I'm going to be watching out for is going to be the bullish continuation, which is the highest quality setup that we might see going into tomorrow, especially with PPI. Fundamentally, this assumes that the macro drivers will remain intact, which is the dollar weakness, the hedging demand, and no new shock that will break the gold's roll right now. Technically, I need price to hold above this 5,300 mark, and then I want to see that failed continuation lower, long lower wicks, and compression on the 15-minute chart, which basically means that I want to see that clean break and retest set up around its 5,300 mark prior to looking for that continuation to the upside. Price did break above it, but we're coming right back down, sitting around this 5,300 area. The trigger here is going to be a full break above 5,300, specifically 5,320 area where price is kind of hanging around right now. And a wick is not going to be enough. So I want to see a full candle closure, full support formation, and then a continuation up. The entry is basically on the break and retest or the pullback retest holding above this 5,300 level. And then the stops would be right below the 5,300, below the rejection low with hard invalidation on the 15-minute level of 5,280 level. The targets, the first one is going to be 5,360 and then 5,420, which is coming right back up into this level right here, the gap that we see. And then we're going to leave runners towards the 5,480 to 5,520 area, which is right into that previous consolidation. And that is only if the momentum rebuilds. We have the next scenario here, which is going to be more like a tactical short, but it's not a macro bearish call. It's simply going to be a liquidity rotation trade that we're going to take. And it's only valid if on the 15-minute time frame, I can get a close below that 5,280 level, which is all this consolidation to the left, followed by a retest of 5,300. So basically looking for price to pull back down into this area, get candle closures, pull back, grab some more liquidity, and then continue pushing down. When that happens, the first target being around the 5,180 level, and then a further continuation down into 5,080, which is that previous wick rejection and liquidity grab prior to a pullback up. The stops here are going to be placed right at 5,300 or just above that, which is going to be the above failed retest high, which is wherever price will retest here. Targets again 5,200, then 5,120, and then a stretch coming right back down into 5,080 if that liquidation continues that we are seeing from this morning. But if price kind of hangs around right here, doesn't really move, we're not getting those clean candle closures and a push back up, then it's a no trade environment and we're not going to be trading anything here. Looking at silver, so we got some clean moves here on silver, even on the 4-hour time frame, but we're going to drop down to the 1 hour and do our primary analysis there just for short term. Silver needs to be treated a little bit differently than gold. Silver can rally with gold because it benefits from the same macro hedging theme, but it also has a second engine, which is the speculation and leverage. Silver is thinner than gold, it's more sensitive to derivatives activity, and it tends to overshoot both directions. So that is why silver moves look more like squeezes or massive liquidity grabs on both sides, which is also why often silver is called the devil's metal. So the way that we trade silver is going to be very simple. We're going to respect the direction that it's headed in. We're going to demand clean structure and confirmation prior to an entry. And then we are also going to reduce our size because the volatility is structurally higher with silver than it is with gold. On the intraday higher time frames, we see that silver has broken out of a multi-month compression and entered a momentum compression to the upside. And then today's sell-off confirms that volatility is elevated, but again, it's not the moment to take any sort of impulsive trades or anything like that. The 3 zones I'm watching for silver, the first one is going to be the primary pivot zone around 112 to 115. So let's go ahead and mark that off right around here. You can also create this as a zone if you'd like, but I'm going to create it as a line here. This zone matters because it's a key level and it becomes the line between continuation or a deeper corrective move. If price just holds on to this area, we're potentially looking for buy opportunities to the upside. Again, confirmations from the 15-minute, 1 hour, and the 4-hour time frames. The second is scenario or the zone is the upside liquidity zone around 120 to 123 level, which is the previous high right around here, and then massive top wick coming up to 122. But let's just say 120 to be a little bit more conservative. This is where liquidity was taken previously and where the selling pressure can reappear if we do revisit that area once again. The third zone that we're going to be watching for is going to be the 105 to 108 area, which is right into this previous support. Again, you can create this as a zone, so this entire zone here, we're really watching out for. If silver fails the 112 area, if it breaks below it, we get a break and retest set up here, then this lower pocket is going to be the next likely magnet, because that is exactly where price is going to be coming back down. Every time price has held on to this area, I push back up with great momentum. So that's exactly what we're going to be targeting here. When it comes to the actual trade continuations, we're going to drop down to the 15 for that. Scenario 1 is for silver to push bullish, continue with that bullish continuation, but it needs to be solidified before we take those entries. Fundamentally, this scenario assumes macro hedging remains active and speculative flow remains supportive, which means that the dips are always being bought into rather than being sold into or any sort of consolidation. Technically, I would need silver to hold above that 112 area as it's rejecting it here, and then show evidence of defense, which basically means that I want long lower wicks, which is going to be those liquidity grabs like this candle right here, and failure to continue lower back down below that 112 area, or really come back and give me another massive bottom wick rejection. I just want bottom wick rejections and a continuation back up. We already have a massive one right here. And then a clean reclaim of the pivot zone, which basically means break out of that entire area and then continue pushing back up bullish. The entry is going to be on the break and retest above that 115 level, so we can break out of this entire consolidation and not really have to worry about price wicking around or any of that stuff. Or the retest that's going to hold above 112 after a retest and then a push back up. So even here, tap into 115, come back down, give me another break and retest, and then continue pushing back up bullish. That's the ideal entry, or else we fake getting faked out here with breakouts and then coming right back down into this consolidation level. Stops will go below the rejection low. So if the entries are going to be somewhere here, let's say price breaks above this, then I want my stops to be sitting around that 112.7, 113, or 112 area. If we see a continuation above it, we could have a tighter stop loss, but right now this is where it seems like it would be if price continues pushing past that level. And that is simply based off the 15-minute time frame. If price pushes right back down below the 112 level, or even closer to this level here, then we're not taking any trades. No trade whatsoever. We just stay out of the market. The targets here are going to be conservative just because of that volatility. So if price can break above 115, then I would be targeting 118, which is right into this previous consolidation resistance. Second target is going to be 120. And then if we can break past that, then I don't really doubt that price can continue pushing back up to 123. And then you can let a runner go only if you see that momentum building up very cleanly, which basically means that break-in or pullbacks and continuation back up and nice break and retest entries. Scenario 3 is going to be a tactical corrective short, and just like gold, it's not a macro bearish call. It's only valid if on a 15-minute time frame we can see price breaking below the 112 level. Give me a break and retest anywhere between 112 to 115, and then continue pushing back down with a massive bearish pressure to the downside. Entry is always going to be below 112. You want to break and retest. Your stops are going to be above that 112 level, even 113, depending on your risk and your position size. And then the targets are going to be 108, which is this previous support, and then continuation down into 105. And then after that, if you see that price continues pushing back down, there's more seller's pressure, then you can't let runners go, but this would be the ultimate target for myself. The limitations here with silver is that number one, your position sizing needs to be smaller than it would be for gold. Number two is that your profit taking needs to be much faster. So you can't really just sit here in a wait and hope kind of a scenario, just hoping that price is going to continue pushing. When you see that momentum, take your profit, kind of get out of the market or manage your trade. You can move to break even, you can trail your stop loss, all that stuff. And number three, that if it doesn't move quickly, then exit pretty quick, because silver will do a lot of whiplashes, it'll do a lot of wick rejections, and it's going to take you out a lot faster. It's less forgiving than gold, so you have to make sure that your risk management is pretty much on point. So the bottom line for right now, going into the end of the week and early next week, is that gold remains a structural hedge, but after this month's move, it can behave as a source of liquidity. That's why volatility is elevated. Silver is a momentum instrument with a speculative engine, and it overshoots in both directions. So make sure you're following the fundamentals because that's really what's defining the environment right now. We have great structure on both sides, and your execution needs to be on point when it comes to the 15-minute time frame and the 1-hour time frame. Make sure you're not chasing any sort of breakouts or looking for any impulsive entries. You're only trading break and retest or corrective moves and then clear support resistance formation and then a continuation. If you don't see that, stay out of the market. You don't want to give back the profits that we've already made in the last couple of days.